The strategies and concepts discussed are for educational purposes only and do not represent specific investment, tax, or estate planning advice. Investing carries an inherent element of risk, and it is possible to lose principal and interest when investing in securities. No strategy can guarantee a profit or prevent against a loss. The views expressed represent the personal opinions of the presenter or the featured guests, not necessarily those of USA Financial or its affiliated subsidiaries. Any opinions or forecasting statements are subject to change at any time and without notice. John Cyndia is an investment advisor representative of, and advisory services are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor. Welcome to episode 56 to Wealth, Tax, and Finance. I'm your host, John Cyndia, certified public accountant and personal financial specialist. What I want you to do today, first of all, make sure you're following us not only on our podcast, but on our YouTube, especially with this episode, because we're going to start with a little bit more detail and giving you better graphics and things that you will hopefully be able to use, whether that's your left brain or your right brain or whatever, for you non-empirical type people, whenever you get to see pictures and colors and all that stuff. But like us, we want to hear about your comments and any suggestions too, because comment back at jcyndia@lifestagesadvisory.com, and we'll make sure that either we get back to you with the comments, information, questions that you have on the next episode. Speaking of episodes, the last time we were on, I was trying to leave you in a little bit of suspense with the fact that I was going to talk about a product and an investment and something that most people really are, I can't say that they're totally familiar with, but they've heard about it. And I like to look at it totally different than most people, because it not only gives you protection and investment, you can utilize it for collateral or whatever. I like to call it, and I've deemed this, what's called a super Roth. But in actuality, it's a sort of insurance that you can look at that will actually benefit you. And when we start to look at the new administration coming in and the tax change that they're looking at and going forward with either increased rates or reduced exemptions, this is something that's going to be coming back into not only a personal level, but also an estate planning level and a tax perspective going forward. And the earlier you start with something like this, the better off it's going to be for you. You need at least a good 7 to 10 years to be able to fund this vehicle, okay? And I'm going to show you a little bit. You will be able to still understand it and follow along in the podcast, but it will be a lot more helpful if you go to our YouTube video and be able to watch it there. So what I want to do is run through a very simple example. I'll go through this. If you have questions, like I said, go to jcyndia@lifestagesadvisory.com and give us your comments, questions, anything else you'd like to have more information on, and we can get it out to you. So what we're going to do right now, we're going to assume we start with a $500,000 face value, okay? And like any other insurance product for life, you can get term, you can get whole life, you can get universal life, you can get index life, lots of different kinds of insurance that you can have there. And we're going to be showing you on this example mainly is what's called cash value. Now, when people look at life insurance, it's always been a bad word, life insurance. I don't need life insurance, and that's the thing. It's need. People say, I don't need that. Life insurance is a want product. You have to want to do something with this. You have to either want to leave a legacy, you want to be able to be your own bank, and that's something that we're going to talk about in another episode, is about being able to make sure that you will not have to rely on banks or loan companies or anything else. If you want to be most efficient with your money, we're going to show you how to do that in another episode. But right now, if you look at term insurance, for $500,000, that's going to be the lowest amount you're going to have to pay. If you have something else that's going to cost you more, you're going to want to have something with more benefit. So let's start by looking at this. We start with $500,000, okay? And there's always going to be a minimum and there's going to be a maximum. And the minimum for a premium is going to be set by the insurance company, okay? There's also going to be a maximum. Now, who do you think is going to do that? Well, Uncle Sam, okay? The government is going to set the maximum. And for them to set a maximum, there has to be some other benefit to it in order for individuals wanting to see exactly what it is that they should be paying more money for than paying less for. So if we end up showing we've got the insurance company here, we got the government, and the more we pay, you're wanting to get more of a benefit for it. So if we end up having, like in the 1980s, qualified plans were all the rage, and that's when more 401ks and SEPs and things like that were started. And the government was telling everybody to put money into that because they were moving from defined benefit plans. The old legacy plans that you hear about that would Ford and GM and GE, all of the older companies would have someone worked for every year. They would get a credit of maybe $30. So after 30 years of work, and the contract was up and said, hey, for every year you work, we're going to pay you $30, $40 for that year, you would make $900 to $1,200 upon retirement. Well, those plans used actuaries, and the actuaries would turn around and calculate based on those contracts that were set up how much it was going to cost the company. The older the people got, the more, and the longer they were there, the more it cost the companies. So the companies ended up finally getting on board and switching everything to 401, 403B plans, 457 plans. So where the onus for savings is now on the individual, it was up to that individual to make sure that they set aside some money. There might be matching then with the companies. It was still less than what it would cost the company to fund a defined benefit plan, which was all the company's money. So at that point in time, you had IRAs, 401s, SEPs, 403Bs. So those were all deductible. And when you start looking at a deduction from that, you have to look at it from a standpoint of who's going to benefit from it. And you need to look at it that those contributions are what they call it as deferrals, and there may be a match with the company. But that's not all your money. Okay, you're in bed with Uncle Sam. What I mean by that is if you have a $1,000 deduction, that it's deductible for you currently, but when you go to retire and you pull that money out, you're going to get taxed on it. So it may look like you have $1,000, but really you're going to have maybe $800 because Uncle Sam could be taking 20%, maybe 30%, depending on what tax bracket. Could be 10%. I don't know where your tax brackets are or would be or could be. It's going to be depending on whatever your plan is upon retirement, how much money you're going to be able to have saved back, what are your other investments, and what other sources of income besides Social Security you're going to have. So what you need to look at is that that $1,000 isn't all yours. It's between you and Uncle Sam. So I don't like to look at it as a deferral. I like to look at it as sort of a postponement, okay? So when you're looking at the money that's coming out, you're only postponing that tax payment, okay? So when you look at that, it's delayed for a little while. So when you'll see here what's called a MEC, it's a modified endowment contract. So the government says, okay, you can put X dollars into this contract based on the value of it being $500,000, okay? The insurance company says, we're going to charge you a minimum on that, which would probably be more of a term policy. We're going to charge you a minimum because we have our own actuaries, and for us to make money and to cover you and to be able to pay a death benefit at $500,000, it's going to cost X. The maximum then is going to be X plus, and that is going to allow you to save money. It's going to allow you to defer things. And once you pull that out, you also will have the ability to have non-taxable benefits off of this. But if you go over that, the MEC becomes a modified endowment contract. Then what they say is, if we allow you to put $10,000 in a year for that $500,000 contract, and you put in $11,000, you've just now blown up the contract, and they're going to revert it back as if it was an IRA, a 401k, a 457, a SEP, a 403b, or whatever. So if you try to pull that money out, they're going to start taxing you on it now. So you've got definite constraints on this contract, but if you use them properly, there's a tremendous benefit in here. And let us proceed on this, and I'll show you a little bit more about that and how exactly this is going to be what I think is going to be a part of everybody, and it should be a part of everyone's financial plan, retirement plan going forward. I've been using this for years with clients on my own. We end up having, they're in 401ks, they have their regular non-qualified brokerage accounts. Some of them have Roths. A lot of them, clients want to put into a Roth and they can't do it because of they're either earning too much money, which is normally the case, or they can't put enough of it away. They've got additional income that they'd like to utilize from disposable income, but they are constrained by the amounts that you can contribute per year because of the instrument that it is, or because of the income that they're making. And that's why what I've deemed this my own as a super Roth, is the fact that you can put in as much as you want, you can dictate that, and it's only going to be based on the constraints of your health, your income, and certain things from that on an underwriting base. But as we go in here, I'll show you a little bit more about that. So we look at $500 would be the term type policy, and $10,000 would be if we're going to have a permanent type cash value insurance, okay? Term, you'll see here, is at the bottom, and we're looking at it mainly for a death benefit. And that's the thing. Most people say, I don't need that. And that's exactly what we want to look at today, a need versus a want, okay? I don't sell any of this stuff. I look at it and ask you questions until you feel comfortable with something, okay? And while I have term insurance also have permanent insurance. And I think there is a place for everything. The application of that instrument is where most people get derailed and become very inefficient with their plan. A lot of times, if you're looking at a retiree that's in their 80s and they need income, you're probably not going to buy Facebook stock, okay, or GameStop like was happening here in the past few weeks or whatever. So it's not to say GameStop or Facebook isn't a good investment. It just was a bad application, especially if you wanted something for income. That's GameStop was speculative, and Facebook is more of a growth-oriented company. So what we want to look at here is that does it make sense to have a little bit of both? And I think that answer is more than likely yes also. You can have certain things targeted for term insurance for a very specific period of time, and then when you look at it from a standpoint of permanent insurance, you're looking for that for the different types of utility. And I'll show you here in a few minutes exactly what I'm talking about and how flexible this type of instrument can be. Okay. First of all, when you're looking at this cash value type policy, you've got tax deferred growth. Okay. So we're putting in, say, $10,000 a year in premium. Might do it for 10 years. It could be for 20. At the outset, when that $500,000 policy is in there, what you're looking at is to try and maximize the cash that you can put away, okay? So that $10,000 premium, if we wanted to maximize this $500,000 contract, it's based on that face value. That $10,000 premium may also be able to control a $2 million policy for that same individual. The thing is, it's not going to accumulate cash. And in this instance, what we want to do is our primary goal is to accumulate cash. Secondarily is to have the death benefit, which is the $500,000. So there again, our want here is to increase our cash and our potential for supplemental income. Okay. Tax-free distribution. At the end of your accumulation phase and you go into a retirement, you can take tax-free distributions, and we can calculate that up front and say if we put in $10,000 for 10 years, we leave it in there for the 10, 15 years or whatever. At the period of time we take it out, we might be able to pull out $15,000 for 20, 30 years. And it's all going to be tax-free while maintaining the death benefit, okay? So these are all things to look at that you can't do with a qualified plan. There again, with an IRA, you're going to be limited to $6,000 or $7,000 if you're over 50. 401ks, you're up to around 19 to 25, 26,000 with over 50 contributions. Same thing with 403bs. SEPs are 16 to 18,000 plus what you can put in over the 50 limit. But with the super Roth that I like to call, or the cash value policy here, say you had $30,000 you could put away, or $50,000. I've got clients that are putting in $60,000, $70,000 a year. Okay, they might have $1.5 million to $2 million of coverage, but that allows them to put away even larger sums of money. The only difference is if you're making more money, you can actually have a larger contract, and the larger and the more you put in. That's why I was saying we're not limited by regulatory constraints from the perspective of a qualified plan. So if we have discretionary dollars we want to put in, we can end up putting in an amount based on what our age, our health is, how much our income is, and keep buying as much as we want once that number is known. Okay, so we pull out the tax-free distributions. We also have a competitive return. Some of these may have 4.5%, 5% fixed returns. There are index-type policies that we've been able to see returns of anywhere from 4.5% to 6, 7%. And it's a type of situation that you have to look at to see what's going to be beneficial for you and how much of an exact number do you want. If you're dealing more of a whole life policy that has a specific fixed amount, then we can tell you exactly what that number will be upon retirement. It could be higher with an index type of a policy, but we can't give you a specific because it is tied to market performance. High contributions. There again, we can make contributions. This one case here is $10,000. If they didn't have a 401k at work and they could only do maybe a Roth, they'd be limited to $6,000, $7,000 if they were over 50. So we could actually put $3,000 more away in this simple example here. And when it comes time to pull that out, even if it was a Roth that they had an opportunity for, this would also give them a tax-free distribution, but they're able to put more money away. Additional benefits. Some of the other things that we'd be able to see off of this would be utilizing these contracts as collateral. You could also turn around and pay for college education out of these. You could borrow money for a car, for a business purpose. There are many other things you can do, and you can't do that with any qualified plan money. You cannot use any of that as collateral. Here we're talking about on the Collateral Opportunities side also, whether it's an IRA that you have personally or if it's a 401k. You can borrow off a 401k, usually up to 50%. During the COVID here, it's been able to be up to 100%. but you have to have that paid off in the 60 months paid back into it. But there are no capabilities of utilizing that as collateral. On this, you can use it as collateral, and I think there's a misconception here that a lot of people think that they're actually borrowing money like a savings account when they have this. And the whole idea of this is to maintain the compounding factor of money. So say you have $100,000 into this policy, okay, and you borrow $50,000. Well, you're not taking that $50,000 out of the 100. The 100 is still in that policy. The insurance company is loaning you that $50,000, okay? They're using your $100,000 as collateral. So whatever that contract is, if it's earning, say, 6% on an index, it's going to earn $6,000. It's not going to earn $3,000, okay? So it would still be having a $6,000 accumulation for that 100,000. It's the fact that you have the ability to pay that back and utilize the lower interest rates that you could get from probably going to a bank or having a credit card, obviously, or anything else. So you are becoming your own bank, and by putting yourself in the driver's seat with your own money, now you're able to be your own finance company, okay? These are safe because they are guaranteed. It's an insurance policy, so the insurance companies have built-in safety factors with these. When you deal with a whole life policy, that's a guaranteed contract in there. When you're dealing with whether it's universal life or indexed life, you also have the fact of the backing of the insurance company. So you want to make sure, as we do, that we're usually dealing with double or some of the AAA companies that are still left. So it's a very strong company that you're going to look at. If something would happen there, as there have been in the past, AIG comes to mind. The other insurance companies around it took over those policies and were able to not have any of those go into default. So when you have the community of the other insurance companies, they will be there. You also have governmental, whether it's by state issuance, that will will have guarantees in there. You've got several layers of safety on these contracts. No loss provisions there again. These are not exposed to the market. Even though an index policy follows the market, it's not exposed to the market. So there is no chance of losing anything when you're dealing with these contracts. Whatever you put in, you're going to be getting back out either through a death benefit or from the accumulation of the interest and dividends that are paid in here. Guaranteed loan option. You can have a loan that you can either pay back the interest, you can pay back the loan entirely, you can have it paid over a period of time, you can have uneven payments, which should be the next thing here, is unstructured loan payments. That's the great thing. Not only can you be guaranteed to get a loan, whereas if you go to a bank, I'm sure everybody's been turned down at one point in time in their life, whether or not you didn't have enough credit history, you had too much other debt recurring, you didn't have enough income or anything else to show. But when you're looking at it from a guarantee standpoint, you've got the ability to take money out anytime you have for any type of emergency or a personal level. The unstructured loan payments is great because, say you go to the bank and you needed $10,000. Okay, they're going to tell you got to pay that in 36 months. Well, I need $10,000 and I'm going to pay back $2,000 this year. I don't want to pay anything else except the interest for the next 5, and then I might pay it in 10 years. You could do something that way. You could never have that paid off. It's strictly up to you, because at some point, usually about the 7th or 8th year, when these start to the contracts start to really, really get some steam behind them because of the accumulation of cash and because of the compounding effect of the uninterrupted interest or dividends that are being paid in here. It gives you the ability to really start to accumulate some nice money at that point. And even though you have a loan there, it's still going to increase, okay? Because like I said, we have 100% of the proceeds in there, and that loan is given by the insurance company. So you can still have an increase on your total value, your cash value in this policy, and have a loan and still not have it affect your ability to either take additional loans for collateral opportunities on that, or even start, albeit at a smaller or a lower level, to extract some pension benefits for supplemental cash flow. Liquidity use and control. This is another big thing that once that money is in there, that's your cash. You can borrow it. You have the ability to utilize that at any point in time because the balance of the cash is having that as collateral. And should something happen to you that you unexpectedly died, the loan would be paid off and the balance would be paid to your beneficiaries. Okay, so there's a lot of additional benefits in here that most people don't really tear apart and look at and are not aware of. It's just like, well, it's going to cost me a lot of money, but they don't really understand exactly what all the benefits there are into these policies. Now, the last thing here is deductible contributions. That's the one thing that you cannot do with these is deduct the contributions, unlike the qualified plans. Now, if you start to look, see, we've got 2, 4, 6, 8, 10. We've got 12 items here that we just discussed. One, and I don't even consider it a negative, is the fact that you don't get to have deductible contributions. But if we look at what can we do with qualified plans, let's see, we got tax deferred growth, and like I said, tax postponed growth, because we're not deferring it, we're postponing that tax, whereas we don't have any taxes here. Let's see, we go down a little bit more. It could be safe. It just depends on what you've invested in. But on these, let's see, no loss, no. You can still have the ability to lose money. There's no guarantees on loan options. Even on 401ks, some of the companies won't allow you to take loans. They're all structured, not unstructured. They're not very liquid. So it looks like the only thing is tax-deferred growth and deductible contributions that you get by a qualified plan. Now, the other thing is you go into a qualified plan, and on this postponed situation that they talk about, it's like pretend you borrowed money and somebody says, what's the interest rate? And you go, oh, don't worry about it. I'll charge you whenever I need the money. Right now, I don't need it. You go, oh, okay. Well, when will that be? Well, I don't know. It could be 5 years, could be 10 years from now. Okay. So what's happening here is almost like I'm going to give you $10,000, but I won't need it for 25 years. Oh, okay. And how much do I owe you then? Well, I don't know. I'll tell you in 25 years. So you come back in 25 years and they go, let's see, you owe me $50,000. It's like, what are you talking about? Well, you should have been able to earn enough, and that's what the contract said. Well, if you turn around, you put in 10 grand, and at the time in 25 years when you go to retire, you don't know what the tax rate is, that's what's happening to you, and that's what's going to happen now, because even though we have rates where they are, they could be going up, and they could be going up even more so, because in the past, average interest, or not interest rates, but average tax rates have been around 58%. So I can show you that empirically, but I think what we need to do is stay on this thing with these death benefits and living benefits. So what we're looking at here is, again, to sort of summarize here, we're trying to get the shortest death benefit but allow for more living benefits. And the more we have, it's going to cost a little bit more. But as you can see here, the more we pay, the more ability we're going to have more benefits in here. Okay. And as you'll see, the last thing that's on here is deductible contributions. Tax deferred growth is a given, or tax postponed, that I like to say. And I think the thing is that if you start looking at incorporating this super Roth, that I like to call it, or cash value life policy, give me a call. We can discuss it in further detail and show you exactly how this would work into a larger financial plan for you and your family, and be able to benefit you for years going forward. I want you to, again, like us, love us, make sure that you follow us on YouTube. Check us out on the YouTube, because this I want to know about the comments of these types of apps that I want to utilize going forward here, because we're going to show you a little bit more about financing, how you can utilize some of your cash and look at things a little bit differently. For instance, when you buy a car, when you buy a house, some people will be surprised that making payments faster on a house really doesn't make a whole lot of sense in some cases, and we can prove that empirically here and visually now. And I'd like to know that going forward, so we can utilize some more of these videos and apps that I have available. Again, suggestions, everything from that standpoint. Also, what I'd like to do, if everybody stayed on here for this, is for the first 3 people to give us comments. We now have, I'm going to keep the roar to a minimum here. Fans go wild. Okay. Dean and Remington are doing the wave in here, is what they're doing. Okay. We now have T-shirts, WTF T-shirts. Okay. So for the first 3 to give us comments on the YouTube, and then you can give us your contact information by emailing jcindy@lifestagesadvisory.com, and we will send you a T-shirt. Then you can get online. The crowd goes wild, okay? And we will have all kinds of other stuff. They're laughing in the background. Okay. Anyway, until next time, thank you very much. I hope this was informative, and we'll talk to you soon. Thanks.